Ringgit Malaysia just hit the strongest level against US dollar and Singapore dollar. As of 10th of March 2026, it is trading at 3 ringgit and 94 cents per US dollar, up 22% since 2023, and 3 ringgit and 8 cents per Singapore dollar, up 15% since 2024. Not only that, if you are traveling around the world, you will most likely notice that Ringgit has strengthened against most currencies. But if we zoom out of Ringgit chart, we can see that Ringgit actually fluctuates a lot. And Ringgit is in a long-term downtrend because it's very hard to predict how long Ringgit can remain strong. So in this video, we are going to share 3 ways of how we take advantage of Ringgit at a multi-year high. And second half of the video, we will learn from the history to see how long can Ringgit strength last. 3 things I'm doing now to take advantage of our strong Ringgit. Number 1, convert Ringgit Malaysia into US dollar and Singapore dollar. The first thing that I always do is to convert Ringgit into US dollar or Singapore dollar. The good thing about using Moomoo is that I can convert more than 20,000 ringgit, not like Wise that only limit you at 20,000 ringgit. A small tip for you, always convert during Malaysia working hours for the best rate. Even if you don't buy stocks immediately, you can still earn 3.42% on your USD via Moomoo CashPlus. Number 2, invest in US and Singapore market. With a strong ringgit, to see Apple stock that used to cost you 1,266 ringgit per share, now it only costs you 1,032 ringgit per share. So it's very hard for me to let go of this opportunity to invest in overseas market. For the US market, you can invest in many ETFs. Like I have invested in the World ETF VT in US dollar. And for Singapore market, you can use Moomoo Screener to screen for quality companies. For example, I found ValueMax from Moomoo's dividend screener that shows you a list of Singapore companies that paid dividend consistently. ValueMax has increased their dividend consistently for more than 10 years. And Moomoo, they are the only digital broker that let you trade US and Singapore stocks with zero commission and very low fees. If you haven't opened an account yet, I got an exclusive deal for you. You can get rewards up to 2,000 ringgit, which can give you extra cash to invest. On top of that, you will get 6% guarantee return on your cash in Moomoo CashPlus. Before you deposit, just search special deposit, join now, and key it, do it, what ah? And you will get 200 ringgit worth of Apple share when you deposit 1,000 ringgit and complete 2 buy trades. The third way that I take advantage of strong ringgit is to invest in overseas subscriptions that are charged in USD, like Substack and Bloomberg. These are so much cheaper now. And the best part is, you can claim these as tax reliefs. But the ultimate question is, how long can ringgit strength last? To answer this big question, let's study history. We are going to trace 30-year story of Malaysian economy, from roaring Asian tiger years to recent 2026 recovery. Is the ringgit rise in 2026 sustainable? How long can this strength last? You never know how long can ringgit remain strong, because in the 1990s, ringgit used to be very strong. Let's turn back time to the 1990s, Malaysia Asian tiger years. At that time, Malaysia's GDP was growing at 8 to 9% every year. The manufacturing sector was growing so strong with MNC like Texas Instruments, Intel, AMD, and Hitachi. This huge MNC investing directly into Malaysia E&E industry because of our cheap labor and multilingual workforce. In the 1990s, strong crude oil and palm oil prices also supported the whole economy. In this kind of environment, ringgit was so strong, 2 ringgit and 50 cents per US dollar. Not just that, ringgit was 1 ringgit and 50 cents per Singapore dollar. In short, 2 factors that made Malaysia succeed: natural resources and cheap labor cost. Foreign capital started flowing in, increasing demand for ringgit, making ringgit strong. Malaysia was unstoppable until the Asia financial crisis hit. Our ringgit started falling sharply, from 2 ringgit and 50 cents to 4 ringgit and 88 cents per US dollar, and 1 ringgit and 80 cents to 2 ringgit and 60 cents per Singapore dollar. The Asia financial crisis exposed Malaysia's unstable growth fueled by debt and hot money. And Malaysia was faced with a hard decision to make, the impossible trinity, a decision that all countries eventually need to make. The impossible trinity is a concept that states that a country cannot have all 3 things together at the same time. These 3 things are fixed exchange rate, free capital movement, and independent monetary policy. No country can choose all 3 together and succeed, and you must only choose 2. If you choose fixed exchange rate, you must give up independent monetary policy and cannot set your own interest rate. This is like Hong Kong and Singapore. And if you choose to set your own interest rate, you have to give up fixed exchange rate, and your currency will fluctuate according to market demand. This is the US way. And if you implement fixed exchange rate and also want to set your own interest rate, then you must have very strict capital control. This is like China. And where is Malaysia? Before the Asian financial crisis, Malaysia chose managed exchange rate with free capital movement, and we had limited power in setting domestic interest rate. But when the crisis hit, Ringgit was crashing so fast. Mahathir, the Prime Minister then, set up National Economic Action Council with Daim, Anwar, Norm and Mustafa as key leaders to find a way to solve the capital fight that caused Ringgit to crash. And the solution that they came up with is to break the trinity. Malaysia will adopt a fixed exchange rate and peg Ringgit to 3 ringgit and 80 cents per US dollar. Bank Negara will set our own monetary policy and impose strict capital control. Anwar didn't support this policy, so he was sacked in September 1998 before this policy was implemented. This bold move successfully stopped the bleeding immediately. Malaysia indeed survived the Asian financial crisis, but it came with a huge hidden cost. Unlike South Korea, which used the crisis, let inefficient companies go bankrupt and innovate aggressively out of the crisis, the 3 ringgit and 80 cents peg in Malaysia somehow acted as a shield, not just for economy, but it also protected inefficient local players. And the class of business cronies and GLC under Mahathir was bailed out and saved. Ultimately, Malaysia chose stability and sacrificed creative destruction that we needed to evolve. Is this the right direction? No one knows, because time only flows in one direction and all we can do is to look ahead. Fast forward to July 2005, Malaysia economy recovered and stabilized. The 3 ringgit 80 cents peg was removed. Our ringgit started floating again according to market force. Strict capital control was removed. Bank Negara, they will only intervene if there's extreme volatility. For the next few years, our economy started growing strong again. Ringgit has also strengthened, even hitting 3 ringgit per US dollar in 2011. But this stability was an illusion. Our ringgit was strong because of strong commodity prices. Crude oil and palm oil prices were very high, but Malaysia's structural weakness remained. There's no innovation or high quality labor. Productivity didn't really improve much after the Asian financial crisis, and Malaysia industrial manufacturing still stay in the lower end of the value chain. At the same time, other countries like China, Singapore, Taiwan, Vietnam, and Korea, they were rising, and they are hungry for more. The reality check arrived when commodity supercycle ended. Crude oil and palm oil prices collapsed. Malaysia's heavy reliance on natural resources was exposed. Without high oil prices artificially propping up our currency, a harsh long-term economic rule took over: relative competitiveness. In the long run, exchange rate is a weighing machine. If your neighbor is growing at 4% but you are growing at 2%, your currency will depreciate so that your export remains cheap and competitively priced. To make things worse, the big multinational companies will prefer to invest in high productivity and cheap countries. So investment to low productivity countries like Malaysia will slowly reduce. So when the commodity price declined, our ringgit started its long and painful weakening. The worst hit came in 2015. 1MDB corruption by Najib was exposed. This scandal heavily damaged investor confidence in Malaysia. So investors, they started to look for safer countries to invest. Investments started to flow to other ASEAN countries like Singapore, Vietnam, Indonesia. Singapore positioned itself as regional financial hub and re-exporter, and Vietnam, they opened up and invested heavily into education, actively trying to move up the value chain. Meanwhile, Malaysia suffered from premature deindustrialization. Instead of building high-value industrial base to create a lot of wealthy middle class, then only we shift to services and consumption-based economy. We straight away shift to a consumption-based economy before we become rich. There's no high-value industrial base to create enough wealthy middle class to sustain this consumption-based economy. Lower productivity growth became the new normal, and over time, a depreciating ringgit acted as indirect tax. Every Malaysian savings quietly depreciated without realizing. Malaysian purchasing power in the global stage became weaker simply because we are less competitive than our neighbors. In 2022, Malaysia faced a perfect storm again. Crude oil and palm oil prices started to crash at the same time. US Fed started to increase interest rate from 0 to 5.5% in 16 months, the fastest rate hike in the history. Malaysia is a consumption-based economy that just came out of COVID with 85% household debt. Bank Negara Malaysia cannot increase interest rate beyond 3%. Capital started flowing out of Malaysia to US dollar that was giving 5.5%. Ringgit weakened to all-time low, hitting 4 ringgit and 88 cents per US dollar and 3 ringgit and 53 cents per Singapore dollar. And when you can earn 3.5 times more in your neighbor country, Malaysia top talent started to leave Malaysia for a better life. Malaysia suffered the worst brain drain ever. In short, weak ringgit forced Malaysia to export human labor with innovation capability, the exact thing that Malaysia needed to survive in this modern economy. Fast forward to today, 2026, ringgit is recovering strongly from 4 ringgit 80 cents to 3 ringgit 88 cents per US dollar, 23% increase in a year. Also because of many good reasons that can be separated into long-term and short-term drivers. Two short-term drivers are US is finally cutting their interest rate, so the gap between Malaysia and US interest rate is not that big anymore. The high US debt, unstable US economy, and trade policy made some capital to pull out of US to invest in other emerging markets. So Malaysia capital market and ringgit benefited a lot from this. Bank Negara Malaysia requested GLC and GLIC to repatriate foreign earnings and convert back into ringgit. This created short-term demand for ringgit. There are also two long-term drivers. The global AI cycle triggered a huge semiconductor upcycle, putting Malaysia's semiconductor sector back in high demand. Our export just hit all-time high, and our total trade crossed 3 trillion ringgit for the first time because of this AI boom. Besides, Malaysia's economy started to improve after our government introduced a few big master plans: National Energy Transition Roadmap, NETR, National Industrial Master Plan (NIMP), and National Semiconductor Strategy (NSS). Besides, Malaysia government also made a few critical and long-awaited reforms, setting clear fiscal deficit target of 3% of GDP in 2028, subsidy reform in petrol, diesel, and electricity. All these policy and reforms gave investors more confidence to invest in Malaysia. There are two ways to interpret this moment. The optimistic, they would think that ringgit was fundamentally undervalued. The panic of 2023 pushed it too low, and this recovery is just returned to the fair value supported by long-term ringgit drivers. The pessimistic will think that short-term ringgit drivers are why ringgit is so strong now, and they will see this recovery as cyclical relief. Some even think that AI boom is short-term and one day the bubble will burst and ringgit will continue its structural decline soon. Honestly, no one has the answer. To maintain ringgit's long-term strength, Malaysia must turn this short-term momentum into long-term structural growth. In Maurice Chang's biography, the founder of Taiwan Semiconductor Manufacturing Company TSMC, he once said that an old economy can succeed with these four things: natural resources, human resources, capital, and innovation. But this formula no longer works because natural resources can be replaced with synthetic materials, and capital is abundant and can flow freely anywhere in the world. Even human resources may not give the country competitive advantage anymore because everyone is educated now. So the two success factors in a new economy are a risk-taking talent and innovation capability. For a country to succeed, it needs to have a system that encourages talents to take risks and reward them heavily when their innovations succeed, so that this can create a healthy ecosystem that turns knowledge into profit. Malaysia has introduced Gear Up initiative requiring GLC and GLICs to be the risk taker, investing 120 million ringgit over 5 years into high growth and high value sectors. The National Semiconductor Strategy aims to scale 10 Malaysian-owned semiconductor companies and 100 Malaysian-owned semiconductor companies to achieve 1 billion ringgit revenue. There are already 10 companies identified by government to lead the way. Whether this can be successful, it remains to be seen. Because many analysts also argue that involving GLC and GLIC will crowd out the actual local successful SMEs. Just like how the 1998 Asian financial crisis protected inefficient tycoons from being destroyed. Can you truly have a winner-take-all innovation spirit when the biggest players are government-backed and too big to fail? We will have answers in 2030. And just maybe the ringgit then will reflect Malaysia's true competitiveness. The ringgit will not lie. In the short term, it may be influenced by US interest rate or AI upcycles. But in the long term, ringgit will only be as strong as Malaysians' productivity. It also depends on whether these SMEs can innovate and succeed in the global stage. So we no longer rely on cheap labor and commodity exports so that Malaysia can remain competitive. But all we can do today is to take advantage of our strong ringgit, invest in our future, be it investing in your mind, paying for paid subscription with quality info, or investing in overseas assets because of our strong ringgit. Moomoo is even giving you so many rewards to help you start. There's no excuse not to start now. Stay safe and stay strong investing. I will see you in the next video. Bye bye.